Charlie Munger has always been very vocal about cryptocurrencies. In fact, he once called Bitcoin rat poison. That is a strong statement coming from a billionaire investor who has seen decades of financial markets and cycles. But Munger's warning is not just about Bitcoin. It applies to the whole world of digital currencies and speculative assets that lack real intrinsic value. So why does Charlie Munger avoid cryptocurrencies entirely? The first reason is simple. Cryptocurrencies don't produce anything of value. Unlike a company that makes products, provides services, or generates profits, cryptocurrencies are purely speculative. Their price depends entirely on what someone else is willing to pay. This means the value of crypto is not grounded in reality. It's a bubble waiting to burst if demand falls. Second, cryptocurrencies are extremely volatile. It is not uncommon for a coin like Bitcoin or Ethereum to jump or drop by 20% or more in a single day. For example, imagine you buy Bitcoin at $60,000, and within 24 hours, it drops to $30,000. Many investors panic and sell at a huge loss. Munger prefers investments where the risk is predictable and the downside can be reasonably estimated. Crypto simply doesn't fit that description. Another reason is the hype-driven nature of cryptocurrencies. Most people buy crypto not because they understand it or see long-term value, but because they hope someone else will pay more tomorrow. This is classic speculation, not investing. Munger has always said that true investing is about value, not about gambling or hoping to get rich quickly. Buying crypto because of hype is exactly the kind of behavior he avoids. Munger's approach to investments is very different. He prefers businesses that produce real cash flow, profits, and tangible value. Companies like Coca-Cola, Apple, or Berkshire Hathaway's other holdings have products, loyal customers, and a track record of performance. These businesses grow steadily and can weather market downturns. They provide predictable returns, unlike crypto, which can swing wildly in price without any underlying reason. It's also important to understand the psychological aspect. Many investors fall into the trap of FOMO, fear of missing out. They see friends or media making headlines about cryptocurrency profits and think they need to join in. Munger avoids this kind of emotional trap entirely. He focuses on rational thinking and long-term value, rather than chasing the next trendy asset. The lesson for investors is clear. Avoid speculative hype and invest in things you understand and that have real value. Cryptocurrencies may seem exciting, and some people do make money in them, but for disciplined investors like Munger, they are too risky, too unpredictable, and far outside the circle of competence. To summarize, Charlie Munger avoids cryptocurrencies for three main reasons. No intrinsic value. They don't produce profits or cash flow. High volatility. Prices can drop drastically overnight. Speculative hype. People buy them hoping someone else will pay more. If you want to invest like Charlie Munger, stay away from crypto and focus on businesses and assets that grow steadily over time. Real value, not hype, is the key to building long-term wealth. Day trading and speculation. Charlie Munger is very clear about his stance on short-term trading and speculation. He believes that trying to make quick profits by buying and selling stocks frequently is gambling, not investing. Unlike traditional investing, which focuses on long-term growth and real business value, speculation relies on timing, luck, and predicting market movements, something even the most experienced investors struggle to do consistently. So why does Munger avoid day trading entirely? The first reason is risk. When you buy and sell stocks multiple times in a short period, you are exposed to sudden market swings, news events, and unpredictable price movements. Even small errors in timing can lead to significant losses. Many people enter day trading thinking it's an easy way to make money, but statistics show that the majority of day traders lose money. This is not just a theory. It is a proven fact from decades of market data. Second, day trading creates emotional stress. Munger often emphasizes that emotions are the enemy of rational investing. When trading frequently, investors experience fear, greed, and panic repeatedly. These emotions often lead to impulsive decisions, buying at the top of a rally or selling at the bottom of a dip. Over time, these mistakes compound and can destroy wealth faster than poor long-term investments. Another major problem is opportunity cost. Money spent on short-term speculation could instead be invested in businesses that produce real value. For example, investing in a company like Apple or Coca-Cola and holding for years provides compound growth. Day trading, by contrast, often generates little or no long-term return, while consuming your time, attention, and mental energy. Munger believes in letting money work for you, not constantly moving it in the hope of a quick win. Munger also points out that most people overestimate their ability to predict markets. Stock prices fluctuate for countless reasons: economic data, political news, global events, and even investor psychology. Even professional traders with decades of experience can't consistently outperform the market through short-term moves. Day trading assumes you can predict these movements reliably, which is extremely unlikely. To illustrate, imagine a trader who buys a stock at $100 hoping it will go up to $105 within a day. Instead, news breaks, and the price drops to $90. Panic sets in, and the trader sells at a loss. Meanwhile, a long-term investor who bought the same stock at $100 and held for years might see the price grow to $200 or $300. The short-term trader loses money, while the patient investor profits. Munger's alternative approach is simple. Focus on long-term investments in companies you understand. This means picking businesses with strong fundamentals, predictable earnings, and durable competitive advantages, and then holding them for years or even decades. Long-term investing removes the stress of daily market fluctuations and allows the power of compounding to work for you. Another key lesson from Munger is to avoid the illusion of control. Many traders believe they can control or predict the market, but in reality, most outcomes are beyond their control. By focusing on long-term value rather than short-term gains, you accept uncertainty and remove unnecessary risk. In summary, Charlie Munger avoids day trading and speculation for several reasons. High risk and unpredictability. Short-term movements are extremely volatile. Emotional stress. Frequent trading fuels fear and greed. Opportunity cost. Time and money are better spent on long-term investments. Overestimating skill. Most people cannot consistently predict markets. The takeaway for viewers is clear. Avoid gambling disguised as investing. Stick to businesses and assets you understand. Invest for the long term, and let compounding and patience grow your wealth. Short-term trading may look exciting, but it rarely builds lasting wealth. Companies without a moat. Charlie Munger's investment philosophy is deeply rooted in the concept of an economic moat. But what exactly is a moat? In simple terms, a moat is a competitive advantage that protects a business from its competitors, just like a real moat protects a castle from invaders. This advantage can come in many forms: a strong brand, patents, cost leadership, network effects, or even customer loyalty. Munger avoids companies without a moat, and for good reason. Companies lacking a competitive advantage are vulnerable. They can be easily copied, undercut, or replaced. Over time, this often leads to shrinking profits, declining market share, or even bankruptcy. Investing in such companies is like building a house on sand. It may look fine initially, but any small storm could collapse it. Let's take a simple example. Imagine a small local retail store selling generic products. Another store opens nearby with slightly lower prices. Suddenly, the first store loses customers and revenue. There is nothing unique about the first store. No moat, no loyal customer base, nothing that sets it apart. If you had invested in it, your investment would be at high risk. On the other hand, consider companies like Coca-Cola or Apple, which Munger often praises. Coca-Cola has a brand moat. People recognize and trust the brand worldwide. Apple has multiple moats: its ecosystem of products, strong brand loyalty, and technological innovation. These moats protect their profits and market position, even in highly competitive industries. Why does this matter for investors? Without a moat, a company's profits can be easily eroded by competitors. Price wars, new entrants, or changing trends can destroy shareholder value quickly. Munger avoids such companies because they lack long-term predictability, and investing in unpredictable businesses is risky. Another point Munger emphasizes is the durability of the moat. Some companies may have a temporary advantage, like a new product that is briefly popular. But if competitors can quickly replicate or surpass it, the moat disappears. Munger only invests in businesses with durable moats, advantages that are likely to last decades. An example from the real world would be generic tech startups or small e-commerce websites. They might grow quickly, but without a unique advantage, their growth is fragile and often unsustainable. Investors chasing these companies risk losing their capital when competition increases or trends change. Munger's lesson is clear. Never invest in companies you wouldn't want to own for the long term. The presence of a moat is a key factor in determining whether a business can survive and thrive over decades. If the company has no moat, it's not just risky, it's essentially a gamble. For viewers, the takeaway is simple. Look for a competitive advantage. Strong brand, patents, network effects, or customer loyalty. Check for durability. Will this advantage last for decades, not just months or years? Avoid companies that can be easily replaced or copied. They may look attractive now but are vulnerable in the long term. Investing like Charlie Munger means focusing on quality, predictability, and durability. Moat-less companies may seem cheaper or promising at first glance, but their lack of protection makes them high-risk investments. By sticking to businesses with wide, durable moats, you reduce risk, increase stability, and give your investments the best chance to grow over time. Highly leveraged companies. Charlie Munger is very cautious when it comes to companies that carry high levels of debt, also known as leveraged companies. Leverage, in simple terms, is borrowing money to finance a business or investment. While leverage can amplify profits during good times, it can also amplify losses. And that's exactly why Munger avoids highly leveraged companies. The first reason is financial risk. A highly leveraged company has significant debt obligations that it must pay regardless of how well the business performs. If revenues drop even slightly, the company may struggle to meet its debt payments. This can lead to bankruptcy, restructuring, or loss of shareholder value. In other words, leverage magnifies both gains and losses, but Munger prefers predictable, stable growth over gambling with borrowed money. Second, leverage increases vulnerability during economic downturns. Imagine a company with $100 million in annual revenue and $80 million in debt. During a recession, if revenue drops by 25%, the company may not be able to cover its debt obligations, leading to financial distress. On the other hand, a company with low debt can weather the same downturn and continue to operate normally. Munger's strategy is all about minimizing risk and avoiding catastrophic losses, which is why he shuns highly leveraged companies. Another important point is opportunity cost. Highly leveraged companies often focus on short-term survival or debt repayment instead of long-term growth. Shareholders may see less reinvestment in innovation, expansion, or dividends because the company is busy servicing debt. Munger prefers companies that can reinvest profits into growth without being burdened by debt. Munger also emphasizes the importance of financial stability in a company's management. Debt adds pressure, limits flexibility, and can force management to make poor decisions under stress. For example, during the 2008 financial crisis, many banks and financial institutions collapsed because they were highly leveraged. Their high debt levels left them vulnerable when the market turned, even though some had strong underlying businesses. Munger, however, avoided these risks and focused on companies with strong balance sheets. It's also worth noting that leverage can create psychological risk for investors. When a company carries high debt, even small negative news can trigger a sharp decline in stock price. Investors can panic, sell at a loss, and compound their financial mistakes. Munger avoids this by investing in businesses that are financially sound and resilient, reducing the emotional stress that comes with market swings. To illustrate, consider two hypothetical companies. Company A has low debt, steady revenue, and strong profits. It can survive recessions, invest in growth, and pay consistent dividends. Company B is highly leveraged, with debt far exceeding its profits. Any downturn in revenue can lead to bankruptcy or major losses. Which company would you prefer to invest in? Munger would clearly choose Company A, the financially stable business, even if its growth is slightly slower. Stability and predictability are far more valuable than high-risk leverage. In summary, Charlie Munger avoids highly leveraged companies for several reasons. Financial risk. Debt amplifies losses during tough times. Vulnerability to downturns. Leverage reduces a company's ability to survive recessions. Opportunity cost. Debt can prevent reinvestment in growth and innovation. Management pressure and emotional risk. Debt forces difficult decisions and adds stress for both management and investors. The lesson for viewers is simple. Focus on financially stable companies with manageable or low debt. Leverage may seem attractive in the short term, but it increases risk exponentially. By avoiding highly leveraged companies, you reduce the chance of catastrophic losses and invest like Charlie Munger, with discipline, patience, and long-term thinking. Hot IPOs and fads. Charlie Munger is known for his disciplined and patient investment approach. One area he consistently avoids is hot IPOs and investment fads. While new companies going public can attract a lot of media attention and investor excitement, Munger sees this as a dangerous trap for most investors. So what exactly is a hot IPO? An IPO, or initial public offering, is when a company first sells its shares to the public. Some IPOs are heavily hyped, and everyone seems to want a piece of the action. Prices often skyrocket in the first few days or weeks, creating the illusion of easy profits. But for Munger, hype is not a reason to invest. He believes in fundamentals over excitement. Why does Munger avoid these hot IPOs? The first reason is overvaluation. When everyone rushes to buy, the price of the stock often exceeds the company's actual worth. Investors are paying for hype, not business performance. This is risky because when the initial excitement fades, the stock often falls sharply, leaving late investors with significant losses. Second, IPOs and fads are often unpredictable. Many new companies don't have a proven track record. They may grow quickly at first, but there's no guarantee they will be profitable in the long term. Trends change, competition increases, and what seems like a hot opportunity today may be worthless in a few years. Munger avoids putting money into such uncertain ventures. Third, there is the psychological trap of fear of missing out, FOMO. Investors see others making money in a hot IPO and feel pressure to join in. This leads to impulsive decisions driven by emotion rather than rational analysis. Munger's philosophy is clear. Investing should be logical and grounded in reality, not influenced by hype or peer pressure. Let's consider an example. In the tech sector, there have been many IPOs that initially skyrocketed because of excitement around a new product or service. But within a few months or years, many of these companies failed to meet expectations, and early investors who bought at the peak lost significant money. While a few lucky investors may profit in the short term, the vast majority lose when the hype fades. Munger's alternative is simple. Invest in established companies with proven business models, predictable cash flow, and durable competitive advantages. These companies may not offer the thrill of rapid gains, but they provide stability and long-term growth. For example, Berkshire Hathaway prefers companies that generate consistent earnings and can withstand market fluctuations, rather than chasing the latest fad. Another important lesson from Munger is to ignore short-term noise. Media hype, social trends, and the excitement of a hot stock can cloud judgment. Long-term investors focus on value, not popularity. By avoiding IPOs and fads, you protect yourself from emotional decision-making and the risk of overpaying for temporary excitement. In summary, Charlie Munger avoids hot IPOs and investment fads for several reasons. Overvaluation. Prices often exceed actual business worth. Unpredictability. New companies have no proven track record. Emotional traps. Fear of missing out leads to impulsive decisions. Long-term focus. Stable. Established companies are safer and more predictable. For viewers, the key takeaway is clear. Don't chase hype. Don't buy a stock just because everyone else is talking about it. Focus on businesses that can grow steadily over years or decades. Hot IPOs and fads may seem exciting, but they are risky, unpredictable, and often a recipe for losing money. By avoiding them, you follow Charlie Munger's disciplined, patient approach to investing and build lasting wealth. Complex financial products. Charlie Munger is famous for his simple but powerful rule. If I don't understand it, I don't invest in it. This principle applies strongly to complex financial products, such as derivatives, collateralized debt obligations, CDOs, exotic options, and other sophisticated instruments. While these products may seem profitable or exciting, Munger avoids them because they are often high risk and difficult to fully understand. The first reason Munger avoids complex financial products is lack of transparency. These instruments are designed with complicated structures that are hard to analyze, even for experienced investors. Many factors, such as interest rates, counterparty risk, or market correlations, can affect the outcome in unpredictable ways. If you don't fully understand how a financial product works, you cannot accurately assess its risks or potential returns. Second, complexity often hides risk. During the 2008 financial crisis, many investors and institutions suffered massive losses due to complex mortgage-backed securities and derivatives. These products appeared safe on paper, but their underlying risks were not properly understood. When the housing market collapsed, even sophisticated investors were caught off guard. Munger consistently avoided these types of investments because he recognized that complexity increases the likelihood of unexpected losses. Another key reason is overconfidence and illusion of control. Many investors believe that by using complex products, they can generate higher returns while managing risk. In reality, these instruments are often so complicated that even small mistakes or miscalculations can lead to huge losses. Munger prefers to avoid this trap entirely by investing only in businesses or assets that he fully understands. Munger also emphasizes the importance of simplicity in investing. Simple investments are easier to analyze, predict, and manage. They allow investors to focus on the fundamentals of a business, such as revenue, profit, competitive advantage, and cash flow. Complex financial products, on the other hand, often distract investors from these core principles and can result in speculative behavior. Let's consider an example. Imagine a new derivative that promises high returns by combining multiple underlying assets. The structure is so complex that only a few people fully understand how it works. An unexpected event, like a sudden drop in one of the underlying assets, could cause the entire investment to fail. Even experts might miscalculate the outcome. Munger would simply avoid this product and focus on straightforward investments he understands. Another reason to avoid complex products is cost and hidden fees. Many sophisticated financial instruments include multiple layers of fees, interest, or commissions that reduce the net return. Investors often underestimate these costs, which can eat away at profits over time. Munger prefers investments where the returns are transparent and predictable, without hidden surprises. In summary, Charlie Munger avoids complex financial products for several reasons. Lack of transparency. It's hard to understand all the risks involved. Hidden risks. Complexity can conceal dangers that lead to catastrophic losses. Overconfidence trap. Many believe they can control or predict outcomes, but they can't. Distraction from fundamentals. Complexity diverts attention from the core value of businesses. Hidden costs and fees. These can reduce net returns significantly. The key lesson for viewers is clear. Invest in what you understand. Complexity does not guarantee success. In fact, it often increases the chance of failure. By sticking to simple, understandable investments, companies with strong fundamentals, cash flow, and competitive advantages. You reduce risk and follow the disciplined approach that has made Charlie Munger one of the greatest investors of all time. Anything outside your circle of competence. Charlie Munger's investment philosophy emphasizes the concept of the circle of competence. Simply put, this means you should only invest in areas or industries you fully understand. Trying to invest outside your circle of competence is one of the most common ways investors lose money, and Munger has made it clear that he avoids such investments entirely. So what is a circle of competence? It's the set of topics, industries, or businesses you understand well enough to make rational decisions. For example, if you have a background in technology, you might understand tech companies and their market dynamics. If you have experience in consumer goods, you might understand retail or food industries. The key is knowing the limits of your knowledge. Munger often says that it's okay to make mistakes if you stay within your circle of competence. But venturing into areas you don't understand is extremely risky. Many investors are tempted by exciting trends or hot industries outside their expertise, hoping to get rich quickly. Unfortunately, this often leads to misjudgment, overconfidence, and losses. For example, imagine an investor with no medical or pharmaceutical knowledge trying to pick biotech stocks. They might invest in a company based on hype, media coverage, or rumors about a new drug. Without understanding clinical trials, regulations, or the competitive landscape, the investor is essentially guessing. Munger would avoid this scenario entirely, because it's outside his circle of competence. Another example could be someone trying to trade in foreign currencies without understanding global economics, interest rates, or geopolitical risks. Even small changes in these factors can cause significant losses. Munger's approach is to stick to what you understand and can reasonably predict. By doing so, you reduce risk and increase your chances of long-term success. The circle of competence also encourages continuous learning. Munger doesn't expect you to know everything from the start, but he emphasizes expanding your knowledge within areas you can master. The more you understand a business or industry, the more confident and rational your investment decisions become. Conversely, venturing too far outside your expertise exposes you to unnecessary uncertainty. This principle also applies to complex or trendy investments. Cryptocurrencies, derivatives, hot IPOs, and other speculative assets often fall outside the circle of competence for most investors, including Munger. By avoiding these, Munger protects himself from making mistakes driven by misunderstanding, speculation, or hype. In summary, here's why Charlie Munger avoids investments outside his circle of competence. Higher risk of mistakes. Limited knowledge leads to poor decision-making. Overconfidence trap. Thinking you understand something you don't can be dangerous. Unpredictable outcomes. Without expertise, you can't accurately assess potential returns or risks. Focus on fundamentals. Sticking to what you know allows you to analyze businesses thoroughly. The key takeaway for viewers is simple. Know your limits and invest within them. If you understand an industry, a company, or a financial product deeply, you can make rational decisions with confidence. If you don't, it's better to step back, learn more, or simply avoid that investment. Investing like Charlie Munger is not about chasing every opportunity. It's about discipline, patience, and understanding. By staying within your circle of competence, you reduce risk, make smarter choices, and set yourself up for long-term wealth. Charlie Munger built his fortune not by chasing trends, but by avoiding risky investments. From cryptocurrencies, day trading, and hot IPOs, to leveraged companies, complex products, and businesses outside his expertise, he focused on value, simplicity, and understanding. The lesson is clear. Invest in what you understand, avoid hype and unnecessary risk, and think long-term. Following Munger's approach isn't about quick wins. It's about building lasting wealth the smart way.